My base case has been range bound for a lot of different assets, which basically points towards not very good real returns over, say, a 5+ year period, but not necessarily expecting a crash either. So I've neither been kind of a melt up bull or a deflationary crash bear. I've been more in that range bound camp, which so far has been working out both in the housing market in aggregate and the stock market in aggregate. Obviously, there are very different industries that can be up or down. There are very different geographies that can be up or down. But overall, that's kind of the general path we've been on. And if we look back historically, I kind of classify the long-term debt cycle, Ray Dalio's work, for example, and then additional work I put into it to kind of really flesh out and explore this concept. I know you've covered it quite a bit as well. It's basically the observation that you go through a number of normal business cycles, but you build up instability in the system a couple different ways, including on the public debt side. And so if we characterize the past 40 years, we had ever rising public debts. So whenever we had a recession, we would have interest rates get cut. That allows higher debt levels, and you get lower lows and lower highs in interest rates, and higher highs and higher lows in both private sector and public sector debts as a percentage of GDP. And that coincided with basically the peace dividend, the opening up of the world. China opened up to the world in the 1980s. Soviet Union fell in the early 90s. And so we kind of entered this more connected world for a period of time. And we basically brought Western capital together with Eastern labor and resources. And that was a very kind of productive disinflationary time. Some people were hurt by it, but a lot of people were helped by it. And that's kind of been the era we've been in. And that allowed for lower interest rates. And when you look at the government expenditure, if you have higher and higher debt to GDP, but lower and lower interest rates, your overall interest expense remains manageable. And when we had the global financial crisis, a lot of things changed there. We had a bank recapitalization. We hit the peak in terms of private debt relative to GDP, but we pushed a lot of that debt onto the public sector in multiple countries, especially the United States. And so when we look back at prior long-term debt cycles, they do tend to come in a 1-2 punch. First, you have the private debt bubble kind of break apart, which is disinflationary. But then the second stage is when all that gets pushed up to the public sector, and then that becomes more of an inflationary type of crisis. So kind of ever since the past, call it 3-4 years, we've been in that second phase of the bubble. And so I think that's one of the best ways to look at it from a historical lens. But then, of course, I just think, okay, what is different now in terms of culture, in terms of technology, in terms of just the way the world looks? What is different, even though that's a useful baseline. And it's, these types of periods are always weird. And so there's going to be challenging things to navigate that you didn't necessarily expect, which is why it's useful to have a framework, but to also be very flexible with your thinking to see what sort of curveballs might or may not come, and then, adjust that over time based on what's happening.
Hey, Money Talkers, today we're diving into the clash of the investment titans, Charlie Munger and Warren Buffett, the dynamic duo of Berkshire Hathaway. Spoiler alert, they both hated Bitcoin, but for totally different reasons. We will talk also about SEC drama. They just play their cards in the Bitcoin ETF game. I'm your crypto messenger. I'm your crypto guide. And this is one spicy showdown you don't want to miss. First off, we're saluting Charlie Munger, the investing legend who just left us at 99. He and Buffett were the Batman and Robin of the finance world, and their annual shareholder meetings were like Woodstock for capitalists. People from around the globe gathered for their financial wisdom, and boy, did they have opinions. Now let's talk Bitcoin. During a 2021 shareholder event, Munger went all out, calling Bitcoin's success detestable. Why? Kidnappers, extortionists, he wasn't a fan. Buffett, on the other hand, wasn't vibing with Bitcoin either. He dropped $25 billion for a slice of U.S. farmland, but Bitcoin, nah, not his cup of financial tea. Buffett had a point. He'd rather own farmland or apartment buildings, things that churn out food and rent money. But Bitcoin? Useless, according to him. Munger had his own take, calling Bitcoin stupid and evil. He even thought it made the U.S. look dumb compared to China, which had slammed the Bitcoin door shut. Hold on to your crypto hats. The SEC just pulled a sneaky move, delaying decisions on spot Bitcoin ETFs from Franklin Templeton and Hashdex. They're throwing a curveball, extending the timeline for the final 2 out of the 12 ETF applicants. All eyes were on January 1 for a decision, but nope, the SEC decided to shake things up. But wait, there's more. This SEC wants your 2 cents, literally. They're asking for public input on these ETF proposals. Yep, you can share your thoughts on these applications. It's a 35-day showdown of comments and responses. The SEC is throwing the door wide open for your opinions. And there you have it, money talkers. The clash of Munger and Buffett, the legends who shook the finance world, also the SEC's making moves, setting the stage for a potential Bitcoin ETF approval bonanza. Now let's continue our discussion with Lyn Alden.
Back in early 2022, when it became clear that the Fed was going to be quite hawkish, that was, my expectation was we'd have a recession by kind of later in the year, and that it'd be tough to get interest rates over 3% before you'd have kind of those types of problems. And for the most of 2022, that was correct. We had slowing economic indicators. We had 2 quarters of negative real GDP growth, even though they weren't technically a recession because they didn't have like an unemployment spike and stuff. But we had a period of softness. Asset prices had a pretty bad time across the board. But then by early 2023, I started to see signs that it was playing out differently. That basically the fiscal deficits, ironically from part of that, the monetary tightening, so the higher interest expense from the federal deficits, were starting to actually kind of balance themselves out. They were becoming kind of inflationary and stimulatory. And then when you had the kind of the mini banking crisis and the Fed's willingness to re-inject some liquidity in there to stop contagion, these things really kind of added up to a shift in how I viewed things. So it was, that's an example of being flexible, where you have a view, it starts playing out, but then after a certain point, it kind of starts being a little different. It's almost like if you're very tired and you stay up all night and you just kind of force yourself through it, eventually you almost get like another burst of being awake again. All right. That's kind of what we saw in markets, where they got so tight on the fiscal side and the monetary side that we kind of went past the looking glass towards actually being somewhat stimulatory, because a lot of the private sector debt is low and fixed rate, especially in the household sector and in the investment grade corporate sector. So those industries have held up pretty well, whereas a lot of the U.S. federal debt is short term, and so that's been refinanced at much higher rates. And so we have like 2 very powerful competing forces here. One is that the interest rates are putting downward pressure on a number of interest rate sensitive industries, commercial real estate and small businesses and junk rated companies and the like. But on the other hand, that interest expense is just completely blowing out the deficit, which is on its own, it's a stimulatory inflationary force. And in the past year or so, they've been roughly balanced. So there's been this narrative for several years that they can't create inflation, that the markets are too deflationary for them to do it. And I wrote an article back in 2019 where I said, are bonds in a bubble, or is this a new normal? And the conclusion of the article was it is a bubble. And I talked about how I was like, look, a lot of things look disinflationary, but if in the next downturn, central banks, they can completely change the rules, and they can work with fiscal authorities and just have massive monetized fiscal deficits. It was almost eerie. I didn't talk about a pandemic in that article, but it's almost eerie what happened less than a year after that article came out. It was just completely the rules were changed. And that's what we've seen. And the reason I had that view is because that's when you get towards a sovereign debt kind of cycle nearing its sort of completion. And a completion can take a decade. It doesn't mean a completion like this 6 months. I mean like this era. Right. The rules change. The cycles get tighter. Similarly, during March 2020, I wrote an article called "Why This Isn't Like the Great Depression," and that was like just in the early signs of seeing some of these stimulus. And so my view is, no, this is not going to be disinflationary. This is likely going to be inflationary, because the cavalry's response time is quicker, and because it's more like the 40s, not like the 30s. So I would consider the 2008 crisis to be very similar to the 1929 crisis. That was all the hallmarks of a private debt bubble unwinding. But I think we're past that now. I think now we're towards the sovereign debt bubble. And the closer you get to the sovereign, the quicker the trigger finger is to come in with any sort of thing, because it starts to potentially make the treasury market get illiquid. So if you look last year, during the 2022 gilt market blow up, right? So it's like September of last year, the UK gilt market blew up and the Bank of England had to come in and do emergency QE for a number of weeks, even though they had 10% inflation at the time. And they had to cancel a speech about balance sheet reduction they were going to have the next day because you literally had a vicious cycle of more bond selling. And at the same time, the U.S. Treasury market was like one step behind. It was like very illiquid. Bond auctions were not going well. It was looking very wobbly. And you started to see the Treasury offset the Fed. So even though the Fed was still being somewhat tight, the Treasury started drawing down its Treasury General account and taking other measures. That was kind of the part of the reversal.
If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.